We recommend a sell for Apple. We arrived at a one-year target price of $205.55, which represents a 5.66% downside from the closing price on September 17, 2018. The primary drivers behind our sell recommendation are the maturing smartphone market. We believe that the baby boomers and older generations that are making one-time smartphone purchases have already made them, and they are not going to be purchasing another soon. Our second driver is the technology S-curve. First, when Apple's technology came out, the technology in the phones was increasing at a rapid rate. Today, this has slowed with slight changes to the screen size, processing, or camera to reflect consumer preference. Another driver behind our sell recommendation is the tariffs that are being imposed by the Trump administration. These conflicts with China make it more expensive for Apple to bring their product back to the United States. So what is Apple? Apple is a leading designer, manufacturer, and marketer of telecommunication equipment. They have a diverse customer base ranging from individuals to large corporations to government entities and everything in between. They were founded in 1977 in Cupertino, California, and have come a long way since Steve Jobs was selling handheld computers out of his garage. They were the first company in history to reach $1 trillion in market capitalization.
Now let's talk about the competitive environment that Apple operates in. The technology industry has been rapidly expanding over the past several years. Apple is a large player in this sector and will hold an even larger position when the communications sector is created on September 24th. Large companies such as Alphabet, Facebook, and Twitter are leaving this sector and joining the communications sector, further increasing the market share that Apple has. From an industry standpoint, Apple operates in the telecom industry with large players being Qualcomm, Harris Corp, and CommScope Holdings. Companies in this industry often carry a large amount of debt on their balance sheet, further increasing their PE ratios. As the US is moving into the later stages of the business cycle, we can expect some of the following criteria: higher interest rates impacting the debt on these balance sheets, consumer spending trends expected to stagnate or decline with rising interest rates, and trade tariffs having a direct negative impact on these companies who operate globally. Apple operates in a highly competitive industry with some of the key players including Samsung, HP, Nokia, Sony, Alphabet, and Microsoft. Although Apple is financially dominant when compared to some of the smaller competitors in the industry, they offer limited product lines when compared to the direct competitors such as Samsung and Alphabet. Overall, we believe this market to be very saturated due to the high number of consumers using smartphones already, a plateau of new customers ordering mobile phones, especially within developing countries, and as this moves on, Apple will need to expand their product lines to stay competitive, further increasing expenses, which may increase product diversification risk.
Now to go over the corporate governance of Apple Incorporated. Apple's board consists of 8 directors that make up 3 committees, of which are the Audit and Finance Committee, a Compensation Committee, and a Nominating and Corporate Governance Committee. Of these 8 directors, 7 of them are independent from the company. Along with the board of directors, there is a management team of 24 company executives.
When performing a financial analysis, Apple has shown uncanny financials and recently reached an unprecedented $1 trillion market cap. From a value standpoint, Apple is comparable to the S&P 500, but after seeing a decline over the past several years, Apple's PE has begun to creep higher, and we would expect this trend to continue. Apple has shown consistent profit margins over the years at an average of 38%, but saw a decline in sales in 2016 due to unfavorable consumer conception of the iPhone 7 and Apple Series Watch 2, showing a reliance on consumer trends. When performing a ratio analysis, we found Apple to be financially healthy and very liquid, holding $74 billion in cash and moving inventory very frequently. Apple operates globally. However, they receive a significant portion of their revenue from Asia and the Americas.
Next, to talk further about our valuation for Apple. We utilized the 70-30 split, 70% for our intrinsic model and 30% for our relative valuation. We selected a weighted average cost of capital of 9.5%, which is higher than consensus analyst estimates due to the higher levels of debt on Apple's balance sheet than they have historically had. With this level reducing in the future, we believe they'll come to a more normalized level. we selected a 4% perpetuity growth rate because of the historic growth that Apple has been experiencing and our expectations for them to come to a more normalized level in the future. Then, to talk about our relative valuation. We compared Apple to its direct peers in the telecommunications industry. Taking these, we found that Apple traded at an 18% premium compared to their peers. Based on team analysis, we expected them to only trade at a 10% enterprise value to EBITDA premium. Taking the 70-30 split for our valuation, we arrived at our one-year target price of $205.55, which represents the 5.66% downside over the next year time frame, which is why we believe Apple is a sell.
After a thorough team analysis, we also identified key risks that are associated to Apple Inc. and further emphasizing our sell recommendation. We want to highlight on 3 of those key risks. To start off, foreign exchange rate risk. The US dollar continues to strengthen relative to other currencies. This will pose high costs for Apple to convert its cash, of which 94% of it actually lies overseas, into US dollars. The second key risk we want to highlight is product and service quality problems. Apple relies on consumer loyalty and brand recognition to profit from recurring products. If unexpected problems arise with any products or the quality of services are not to customer expectations, there may be a decrease in predicted sales. And the third and final risk that we would like to highlight on is the demand for key personnel. All in all, Apple Incorporated is a great company, but it is not a great stock, and that is why we recommend a sell.